Great. Good afternoon, everyone, and welcome to the 761st meeting of the Economic Club of New York. My name is Bob Steele. I'm a partner at Perella Weinberg Partners and also vice chairman of the club. Today, it's great to be here with you, and thank you all for attending, both those of you who are in the room and those that are joining us virtually, and also a special welcome to the press. The Economic Club of New York is recognized as the premier nonpartisan forum in our country, a place for discussion on economic, social, and political issues. And for more than a century, the club has hosted over 1,000 preeminent guest speakers, contributing to our long tradition of excellence. I want to especially extend today a welcome to students who are joining us virtually from Fordham, NYU Stern, and the Graduate Center, as well as the members of our largest class ever of fellows, a select group of diverse rising next generation business thought leaders. We're really pleased that you're with us today. So now let me turn to the matter at hand, which is really a great personal privilege, and that is to welcome our honored guest and chair of the club, my boss, John Williams. John is the president and chief executive of the Federal Reserve Bank of New York. In that important capacity, he serves as the vice chair and a permanent member of the Federal Open Market Committee. From 2011 to 2018, John was president and chief executive of the Federal Reserve Bank of San Francisco. And prior to that, he was executive vice president and director of research at the San Francisco Fed, which he had joined in 2002, a distinguished career in service to the Federal Reserve System, for which we're all appreciative, John. John began his career in 1994 as an economist at the Board of Governors and also a senior economist in the White House Council of Economic Advisors and a lecturer at Stanford Business School. He holds a PhD in economics from Stanford and an MS degree from London School of Economics and an AB from the University of California at Berkeley. His research focuses on monetary policy under uncertainty, business cycles, and innovation. He is a research associate at the Center for Applied Mathematics, Macroeconomic Analysis, and served as managing editor of the International Journal of Central Banking from 2011 to 2016. So the run-of show for today is John's going to come up after me and speak to us and provide some perspective from his point of view for about 10 or 15 minutes. And then John will be interviewed by a club member and co-anchor of CNBC Squawk, Sara Eisen, who did this last year for us, and we're really pleased that she's back with us today. So just as a reminder to all of you, the conversations today are all on the record as the press has joined us. So John, welcome and thank you so much.
Thanks, Bob. And it's great to be here today. And I'm honored to be here today among so many Economic Club of New York members, fellows, students, and staff. The club has the privilege of hosting incredible speakers, but it's our members who truly create the robust, dynamic environment for our discussions. So thank you all for being part of this wonderful organization. So as I look ahead to the end of my term as club chair, I'd like to thank my predecessor in the role, Marie-José Kravis, our board members, our tireless president and CEO, Barbara Van Allen, and the small yet remarkably productive staff of the club. When I began my term as chair back in June of 2020, the ECNY was strong and vibrant, all thanks to their vision, their commitment, and hard work. At the same time, 2020 was a period of tremendous uncertainty at the club. After all, our hallmark was in-person events. And with the onset of the pandemic, we needed to reinvent what it meant to be the ECNY in very short order. We all quickly came together and innovated to an incredible degree so that we could reach our members in new ways. Zoom became our meeting room, and we later found success in hybrid events. We launched new programs, including a series focused on diversity, equity, and inclusion, the Innovation and Social Impact Challenge, and the podcast. And we did it while maintaining the financial strength of the club. So here's one statistic that captures the dramatic evolution of the club. Over the past 4 years, we held 100 events. That's 25 per year on average. And that compares to the 660 events that we held in the prior 113 years, or about 6 per year. Now that's a 300% increase in productivity at the club. So just brag about that a little bit. And looking ahead, there are many exciting things planned for the future, and I look forward to watching the club evolve and prosper in the years to come. So for today's discussion, I'll transition away from my role as chair of the ECNY and back to my job as president of the New York Fed. And I'll spend some time focusing on how the Federal Reserve is working to achieve both maximum employment and price stability. I'll also discuss the progress we're seeing in the economy in terms of getting supply and demand in better balance and bringing inflation back down to the Federal Open Market Committee's 2% longer run goal. And finally, I will share my view on where the economy is headed. Of course, I need to give the standard disclaimer that everything I say reflects my own views and not necessarily those of the Federal Open Market Committee or anyone else in the Federal Reserve System. Now, as I never tire in saying, the Federal Reserve's monetary policy goals are clear: maximum employment and price stability. And the overarching objective of monetary policy today is to bring inflation down to 2% over time while maintaining a strong labor market. The good news is that over the past 2 years, we've made considerable progress towards these objectives. After last year's strong GDP and job growth, incoming data point to a slowing but still solid pace of growth in economic activity in the first half of this year. Demand-supply imbalances have diminished. Global supply chains, which were severely disrupted during the pandemic and early in the recovery, have mostly returned to normal. And at the same time, inflation has come down considerably. So let me dive deeper into the maximum employment side of our mandate. First and foremost, the labor market remains quite strong. Labor supply has been boosted by high levels of labor force participation among individuals aged 25 to 54 years, as well as by increased immigration flows. The unemployment rate has been under 4% for more than 2 years, and that's the longest such stretch in over 50 years. This measure, which now stands at 3.9%, is close to my estimate for the unemployment rate that's likely to prevail over the longer run. So even as the economy and the labor market remain strong, various labor market indicators show that demand-supply imbalances that emerged following the pandemic continue to recede. Most of these measures have returned to pre-pandemic levels. Two are still signaling a tighter labor market than before the pandemic: job vacancies and wage growth. After skyrocketing over the course of 2021 and early 2022, the rate of job openings has subsequently steadily declined, but still remains elevated relative to pre-pandemic levels. Wage growth has displayed a similar pattern, including for so-called job switchers, for whom wage growth is highly sensitive to labor market conditions. That said, wage growth is yet to fully return to levels consistent with 2% price inflation on a sustained basis. So that provides a nice segue to the topic of inflation, the other half of our mandate. Inflation's declined significantly since mid-2022. This drop has been broad-based, with inflation lower in all major categories: food, energy, goods, and services. The 12-month percent change in the personal consumption expenditures price index has continued to decline, falling from its 40-year high of above 7% back in mid-2022 to 2.7% in the latest reading. And the decline in inflation has benefited from a reduction in the demand and supply imbalances that I mentioned, both here in the US, but importantly also internationally. Indeed, this phenomenon is not unique to the United States. If you look at Canada, the United Kingdom, or other European economies, they all experience historically high inflation and have similarly seen relatively rapid declines in inflation since then. In fact, if you look at one particular statistic, which is commonly used to compare inflation across countries, called the Harmonized Index of Consumer Prices, the inflation rates in the Euro area, Sweden, the United Kingdom, and the United States today are all nearly the same level. While every region has its own set of conditions, global factors have been a large factor. Global factors have been driving inflation in advanced economies across the globe. Even with this good news, inflation in the United States remains too high, and in recent months, there has been a lack of further progress towards our 2% goal. Now, extracting the signal from the noise when it comes to reading inflation is especially challenging these days, since the economy is still feeling the aftermath of the supply chain issues and high inflation that followed the pandemic and the war in Ukraine. I'll point to a few areas of research developed by my colleagues at the New York Fed to better understand the inflation data. The one that I find really valuable is what we call the multivariate core trend, or MCT inflation, which is a measure of what a statistical way to measure what's the underlying inflation rate. The most recent reading we have from March was 2.6%. It's about the same as where that measure was back in December, and down 3 percentage points from its peak back in June of 2022. Looking at measures of inflation expectations from our survey of consumer expectations show that they've remained broadly stable and are generally in line with pre-COVID ranges at all horizons. And as I mentioned, global supply chain issues have mostly receded, and we see that both in our global supply chain pressure index at the New York Fed, as well as evidence from our regional surveys of businesses. So overall, I see some of the recent inflation readings as representing mostly a reversal of the unusually low readings of the second half of last year, rather than a break in the overall downward trend of inflation. With the economy coming into better balance over time and the disinflation that's taking place in other economies, reducing inflationary pressures on the US, I expect inflation to resume moderating in the second half of this year. But let me be clear, inflation is still above our 2% longer run target, and I'm very focused on ensuring that we achieve both of our dual mandate goals. So what's it mean for monetary policy? Now, it's important to note the many factors beyond monetary policy influence the economy and financial markets. These include global drivers of supply and demand, as well as factors that are currently affecting the supply side of the US economy that have been driving up GDP and job growth. Therefore, the stance of monetary policy needs to be considered in this broader context, and it cannot be understood simply by looking at the growth rate of the economy or by comparing the current interest rate to its longer run level, or what's often called R star. Looking at this broader context, the behavior of the economy over the past year provides ample evidence that monetary policy is restrictive in a way that helps achieve our goals. We're seeing clear and consistent signs that the imbalances between supply and demand in the economy are receding, and we've seen a broad-based decline in inflation. Overall, the risks to achieving our maximum employment and price stability goals have moved toward better balance over the past year. Now, at our May meeting, the FOMC kept the target range for the federal funds rate unchanged to 5.25% to 5.5%. And the committee said it does not expect it will be appropriate to reduce the target range until it's gained greater confidence that inflation is moving sustainably toward 2%. Additionally, the committee said it will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities, and beginning in June will slow the pace of decline in securities holdings. The decision to slow the pace is in no way indicating an imminent cessation of shrinking the balance sheet. Rather, by slowing the pace, we're better able to monitor conditions and to facilitate a smooth transition to the appropriate level of ample reserves. So I see the current stance of monetary policy as being well positioned to continue the progress we made towards our objectives. In terms of my forecast for the economy, I expect GDP growth to be between 2 and 2.5% this year. I expect the unemployment rate to end the year at about 4%, and then to move gradually back to its longer run level of 3.75% thereafter. And as the growth of economic activity gradually slows and demand and supply continue to come into better balance, I expect overall PC inflation to moderate to about 2.5% this year before moving closer to 2% next year. It goes without saying the outlook is uncertain. The risks are two-sided, with geopolitical events and China's growth outlook prominent examples. Because of this, we will continue to keep an eye on the totality of the data so that we make policy decisions and ensure that we get inflation sustainably back to 2% while maintaining a strong labor market. So I'll close with this. We have seen a great deal of progress towards our goals over the past 2 years. I'm confident that we will restore price stability and set the stage for sustained economic prosperity, and we're committed to getting the job done. Thank you.
Now's the fun part.
I was going to say.
No, that was informative, and there were no Star Wars references.
No, not this time.
Look, it's a pleasure for me to be here in this audience and with you again, President Williams. We were here a year ago, early May, and turns out you only raised interest rates one time between then and now, and then have basically been on hold. And it sounds like you feel pretty good about where policy is right now. Is that true?
Yeah, absolutely. I do feel that going back before we met last time a year ago, we had gotten monetary policy into a better place. It got into a restrictive stance that was doing the job of getting the economy back into better balance with supply and demand help start bringing inflation down. At the time, it was uncertain how far we would need to go and what exactly that meant. I think what we've learned over the past year, as I mentioned in my remarks, is that monetary policy is clearly working the way we'd like to do it, not just here, but around the world. We see, a lot of people are trying to make the point about, well, Europe is slightly different than the UK or US or Canada, but we've actually seen very strong similarities across countries, and we've seen inflation come down. So I think in the US, monetary policy has been in a good place. It's doing what we want to see it do, and that's how I see it right now.
It's interesting that you draw the parallel with Europe because they are set to cut interest rates next week. And you are not set to cut interest rates in a few weeks. Why?
Well, I think, first of all, I won't speak to what they will or will not do at the European Central Bank.
They're pretty clear about it.
No, I'm fully aware. But I think what's happening now is the broad contours of inflation, the large rise, both because of the pandemic and very importantly, Russia's war in Ukraine. That is a huge part of the inflation that we saw, especially with energy prices and commodity prices. We've seen the inflation's peak. It's been coming down, but now we're in where the different countries have different kind of experiences with inflation. Where in Europe, I think inflation has continued to come down relatively quickly. Their economy is in a slightly different place than we are. In the US, again, inflation has come down. We've seen the last few months, inflation kind of not making that further progress that we said that, what we wanted to see, but also our economy is growing really well. Unemployment is staying low. So, again, the broad context, I think, is more similar than dissimilar. The tactical decisions about, how to best make policy, I think there's where you see some of these differences.
Does that factor into your decision and your discussions at the Fed that Europe, potentially Bank of England, Bank of Canada, some of these major central banks, you were all coordinated and they're going before you? Does that matter to you?
We always think about what's happening in the rest of the world, what's happening in terms of growth, inflation, and all the different factors. And that obviously spills into our economy. The high inflation around the world was one of the factors that boosted our inflation because import prices were so high. So as we clearly we think about what's happening around the world. Again, I would see the actions either that have been taken by some central banks or may be taken by other central banks as reflecting where their economies are in terms of their journey to get inflation back to target, where their economies are in terms of labor market and growth. And so, to me, it's not something I worry about or a concern. It really just reflects the progress that other countries have made in achieving their goals. And we're in a slightly different place right now, but that's not
slightly. How slightly?
In terms of, well, I think.
Well, when are we going to be cutting rates?
I knew you were going to ask.
What date, please?
No,
September or December?
I don't, honestly, the honest answer is I don't know because this can be driven by the data. But it's a very comfortable place to be for monetary policy from my perspective. We have a strong economy. We have good growth. If you read through the data, we're still seeing good growth in economic activity, labor market. We're seeing the imbalances come down, and the inflation data, been a little bumpy earlier on, but have to watch how that proceeds. So it's really about looking at the totality of the data, getting that greater confidence that we're moving sustainably to 2%, and really understanding the broader context. I do think that monetary policy is restrictive and is bringing the economy into better balance. So I think at some point, interest rates in the US will, based on that analysis, will eventually need to come down, but the timing will be driven by how we're doing on achieving our goals and how do we best balance the various risks to the economy. You
said it's been a little bumpy, the inflation data. Mm-hmm. So what would give you more confidence that would allow you to cut rates?
Well, again, it's really looking at the inflation data and all the factors that I think influence inflation, which includes labor market indicators, wage growth, all these others, and that they're showing broadly consistent signs that inflation is continuing to move towards 2%. So we got some kind of high readings in a couple of the months of the first 4 months of the year. So it's not looking for a specific number on a CPI or PCE. That's not the way I think about it. I don't want to be data point dependent, but looking at kind of what are we seeing over time and what are we seeing across a broad set of indicators. So it's really trying to get all that information, importantly around the maximum employment goal too, because I do think that the risks to our two goals are are moving into closer balance. So from a very simple way, we don't want to have excessively tight policy that harms our maximum employment goal, but we want to make sure that we get inflation to 2% on a sustained basis. That's absolutely critical.
Okay, I'll just ask it one more way, which is,
I feel like last year.
yeah. Well, you had me back, so that's a good sign. Is it many more months of data, or is it a few more months of data? Is it one more month of data? Like how close are you to feeling confident about the cutting situation?
Well, personally, because the economy has held up and been so resilient here in the US and quite honestly in other countries, I do feel like I can collect more data and on the inflation side, and again, looking at all the data, I don't feel any urgency or need to, hey, we have to make a decision now because things are going in the wrong direction. I feel things are going in the right direction, and this current stance of policy is well positioned. So I think that, again, I'm not going to answer on any calendars or anything like that, but based on the data, it's not, I don't feel like any kind of need that we need to move policy in one direction, cut rates is the question you asked. In the very near term.
And you said you're not targeting an inflation rate. Obviously, 2% is the target,
Yeah.
but you'll move before you get to 2%. So is there a level that feels more comfortable than where we are right now?
Well, you're right about that. We don't need to be at 2% and already, because with a restrictive stance of policy, that would be kind of, moving inflation probably too low in that case. So we want to be able to move before inflation is all the way to 2%. I think it's kind of looking at all the measures. I think I mentioned the MCT, the multivariate core trend inflation is at 2.6. Core inflation is still higher. It's kind of looking to see if all those things are kind of moving consistently towards 2%. We were starting to see that clearly last year. Now, I was not one of the people and that was saying, oh, we reached 2% because we had 6 months of good inflation data, because I felt some of that was artificially lower for special factors. I think some of the higher readings were also maybe artificially higher, but it's looking for that consistent kind of signal that inflation is moving towards the 2%.
If you look at the reason why inflation has been stickier lately, home prices, and there's an inventory problem there, it's not necessarily a demand issue. Insurance rates are high in auto insurance and in health insurance. These aren't really things that the Fed can control, are they?
We can control the overall inflation rate. So it's true that if you think about relative prices, the price of a car versus the price of insurance or things like that, that's going to be determined in the economy. But we can influence, and we will, and we do influence the overall inflation rate. Now, I do think you're bringing up an important point, though. Some of the kind of high inflation readings we saw in the first few months of the year were really echoes of high inflation from before. So one of the examples was auto insurance. Auto prices, we all know this, we see this, skyrocketed during the pandemic and the war. There was severe supply chain disruptions, used car prices went through the roof. And now, we're seeing the auto insurance rates, which tend to lag that, now kind of catch up to what the cost of replacing a car is. So those are not things that reflect where the economy is today. These are kind of inflation movements that reflect where the economy was a couple of years ago. So I kind of think of these as echoes. Some people call this catch-up kind of dynamics in inflation. So it is important from my perspective to not look at, to kind of understand why that happened, because it's probably not going to happen every year, in the next few years, that auto insurance rates are going to keep going up. Some of the other factors are, like you mentioned with the shelter prices. So shelter inflation, rent inflation has definitely been a big driver of inflation.
It's like a third of CPI. Right?
It's a very large part of the price index, but we also know that the measures that we have that we can now see on the rents that people are paying on newly signed leases, that rent inflation has been actually subdued from that last year. Now, the translation of that actual market data into the official statistics is taking a bit longer than it has in the past, and there's different factors that affect that. They're kind of deep in the weeds of this, but I do think looking ahead, I do expect shelter inflation to keep coming down, because we know that the prices that people are actually paying to rent homes, rent apartments, that inflation rate has come down. It does take a while to get that into the official data. So it's really about looking ahead to where things are going rather than what happened a couple years ago. So that's one of the kind of reasons I think that some of the high readings were maybe kind of unusual high readings, but we have to be humble. I mean, inflation could surprise us again.
What is your forecast as to when you'll reach 2%?
So my forecast would be in probably early 2026 or something. We'll see. That's getting way out there. Right now, I have inflation about 2.5% for this year as a whole, like over the full year, and closer to 2% next year. Of course, the uncertainty gets bigger there, but basically moving pretty close to 2% by the end of next year.
And the reference there is core PCE. Is that what we
No,
should do?
PCE inflation is the
PCE.
way I'm thinking about it. Over longer periods, they move together. Core is, I find, it excludes the food and energy prices. Is a helpful way to kind of read the kind of what's the underlying inflation. I personally like this multivariate core.
Multivariate. We're all over.
MCT, everyone, it's free. It's on our website. You don't even have to subscribe.
I have used it on TV before.
That's excellent.
But I don't do it how often is it published?
Well, it's published with every PC release every month.
Every month. Okay.
Yeah, so we'll be getting one out, I think, on Monday. I think it's right.
And it's at 2.6%.
As of March, but we'll get some data tomorrow,
Right. So it sounds like you're closer on the cutting front than maybe some of your others on the committee.
Well, we're all looking at the same data, and honestly, one of the strengths of the Federal Reserve System and the FOMC is we have 19 participants in the committee, 12 presidents and 7 governors. We all come from different backgrounds, different experience, different perspectives. We all have our own economics teams, and we all have the same goals: maximum employment, price stability, 2% inflation. So it's kind of an amazing arrangement. We all agree on the goals, and the question is, how do you read the data? What are the risks, the uncertainties around that? So we've seen this very strong unanimity in the committee about the dedication, commitment, the absolute necessity of getting restoring price stability, getting back to 2%. But everybody's going to see the data, process it, look at different pieces of it, and then as the data come in, that kind of brings, we'll share those views and kind of how we're seeing that. So to me, there's a lot of uncertainty about how things are going to play out. Once we get the next readings on the data, that kind of clarifies a little bit, and then just keep rolling that forward. I think again, that's why where we got policy, we talked like a year ago, we were close to getting policy a good place. This is allowing us right now, where policy's been now for quite some time, is allowing us to collect that data, observe what's going on, kind of seeing which risks are being realized, which aren't, and get that kind of greater confidence that we're getting the job done on the 2%.
But you're done with hikes for now, right?
Well, that's not my baseline, as I've often said. I feel the monetary policy is restrictive in its current stance. Obviously, we think a lot of scenario analysis. Things can change. Events around the world could change, and we could be surprised. And if there was a kind of a material change in the inflation outlook to the upside, or obviously we be willing or be ready to take whatever actions to make sure we bring inflation back to 2% on a sustained basis. We proved we would do that, and can and will do that during the last hiking cycle. And I don't see that as a likely case, but. Really, I think it's more about right now we got policy in a good place, and just watch the data.
So you've said it now a few times that you see policy as restrictive, which is also kind of a debate of just how restrictive policy is right now, given the recovery has been much stronger than I'm sure you and everybody else thought it would be, given where interest rates are right now. So where do you see it being restrictive? Yeah,
so I think there's a point I was trying to emphasize in my prepared remarks is the big surprise of 2023 by far for the macroeconomy was the supply side of the economy. So we saw GDP growth last year of over 3%, which is well over most people's estimates of its trend level of 2%. We added something like 3 million jobs. This economy was incredibly strong on numbers, GDP, jobs, and everything. But then when you look at the unemployment rate actually edged up a little bit, a couple tenths, I think, last year. So that makes you, as an economist, I only know 2 words: supply, demand. Well, there's R-star too, but okay. So I know 3 words.
We can get to R-star.
So I know, so if you think about it, economy that's adding millions of jobs, growing at 3%, and yet unemployment's going up, and the supply-demand imbalances that I kind of went through in my remarks, they were receding. So that's telling you demand was actually getting closer to supply. It was supply that surprised us. So I think from a monetary policy point of view, The 3% GDP growth last year, for example, wasn't a sign that monetary policy wasn't working, because we actually saw all pretty much every indicator of labor market tightness, go from a very, we saw a receding, imbalance in supply and demand in the labor market, whether it's, job quit rates, whether it's surveys of businesses, surveys of households, all the data in the employment data that we look at. And we saw it in the wage data too, where inflation came down. So I think what we saw was a combination of two things in last year. One is very positive supply developments on the labor market and productivity. And we saw demand moving back more in alignment with supply. So when my view is that you can't just look at like, wow, we had a strong economy, it's going well, monetary policy isn't working, because I think it is working on all these other indicators of imbalances in the economy and wage and price inflation. I think the big question for us this year is, are these supply side, positive supply side developments in productivity and labor force likely to continue? Or are we going to have another year where we're getting a nice tailwind from the supply side? So far, the labor market data or the labor supply data look like that is happening. We'll see about productivity. That's a kind of.
Is this because of fiscal stimulus?
I think a lot of the supply side, well, a lot of it is, labor force participation fell dramatically during the pandemic. And a big question a few years ago was, would people come back to work? What would that look like? We've seen labor force participation of the group that's 25 to 54, which I call the very young. So we've seen them come back in. I believe the latest data for women, it's actually higher than it was before the pandemic. For men, it's also very strong. So we've seen like the economy prove itself far more resilient on the supply side to the pandemic and everything that's happened than I think most people imagine. We do measures of, what was trend productivity? What did we think productivity would be like? You can go back to 2019. And we're basically at or somewhat above the productivity in the U.S. economy is actually at or above what we would have thought if you had asked me 4 years ago. So we've seen a lot of positive developments on the supply side. Some of it may be the fiscal policy actions during the pandemic that made sure that businesses didn't close, that people could get through this and be able to, kind of start the economy again. We've seen enormous creation of small businesses and startups in the U.S. economy in the last couple of years. So we're seeing a lot of positives. Honestly, that makes my job easier because supply is great. It kind of helps with getting the imbalances, reduce the imbalances. It's kind of reduces inflationary pressures because you get a lot of dynamic supply and increase in productivity in the economy. So that's how I see what's happening. It's always a big question mark of how that will evolve in the future.
You didn't mention immigration. Do you think that's part of the story too?
Well, immigration is. I didn't mention it earlier, but so that's clearly a part of more labor supply. One of the stories we heard, whether it's in New York here or around the country, is just a severe shortages of people to work, especially in hospitality, leisure, and quite honestly everything a couple of years ago. Today, those labor supply issues, either through people coming, opening the borders again, people coming in through visas or through immigration, has clearly increased the ability of businesses to hire and especially in like I said, leisure, hospitality, and other industries and construction, to be able to meet demand. I mean, one thing I was just the last 2 days as part of my job, I was visiting the North Country of New York, which is absolutely beautiful region of New York. But these are some of the areas that, upstate New York, which, during the pandemic and shortly after, I mean, businesses just couldn't be open because they didn't have people to work in the restaurants and the hotels or whatever. Those issues seem to have receded. There's still supply. There's still issues with, labor supply and availability of workers and things like that, but nothing like we saw before.
So I guess my question is, to what extent is the labor market cooling right now?
Well, again, I look at a lot of indicators. Like there's a survey of, if you ask households, how hard is it to get a job? That basically the answer to that, which tracks the unemployment rate historically very well, is close to where it was in the strong economy before the pandemic. There's also a survey of small businesses, business owners. How hard is it to fill a position? That similarly, which by the way went through the roof during the pandemic, is now back to where we saw it before the pandemic, We're seeing it also in the churn in the labor market, which was astronomically high. Every one of us who's in a organization, whether business or nonprofit or government, we saw the highest turnover of our lifetimes during the period following the pandemic. Those data have come way down. So there's a lot of indicators that the labor market is cooling, but cooling to kind of a very good, strong labor market level, not kind of getting weak.
You're not using the phrase soft landing, but you're describing soft landing.
No, I'm not.
Are you purposely not using that
I am
phrase?
purposely not using that.
Why?
Because I don't want to jinx things. No, and also it means things different. I'm an economist, so I'm looking at the data and things. So it's what I would love to see is is to see inflation come down to 2%, hopefully over the next year or two, sustainably to 2%, and an economy that stays strong. That's how I view my.
You're kind of pulling that off so far. Right?
Did I mention the jinx word?
Yeah.
Okay, but Sarah, we're trying to create conditions through monetary policy and financial conditions that foster that kind of economic expansion, economic conditions. There's a lot of things, a lot of uncertainty, a lot of things that can happen that can change that. But that's what I'm trying to do.
Well, and as those risks sort of come better into balance, I do wonder which you think is a bigger risk right now, cutting too soon with inflation still at elevated levels, or cutting too late and risking that soft landing.
Yeah, so that's exactly kind of the issue that we will be facing going forward. I think it's not just about a first interest rate. It's always a decision about monetary policy. I think being driven by the data is the best thing we can do, and understanding not only what are the data telling us about where the economy is today, but where it's likely to be going over the next year. That means bringing in all the information and analysis, talking as we all do, to business leaders, others, and in the markets and everywhere to try to get that best understanding. I think it's also about weighing the risks and the uncertainties. As you said, so far, not only in the U.S., but quite honestly, in the other advanced economies, they have seen the disinflation happen with relatively small, low degrees of economic disruption. I mean, some countries have seen technical recessions in Europe and things like that. But we're seeing globally a similar experience where the inflation is coming down, monetary policy is restrictive, and doing that in a way that tries to balance the two goals. So right now, I feel the monetary policy is in the right place, but in well position. Over time, as the data flows in, there will be, I think, a point where you say, okay, we don't need restrictive monetary policy forever. We want to normalize monetary policy because we're on kind of, I'm really now trying to not say those words you said. We are well positioned to achieve those goals and do what's necessary. I think, if I can just say one thing, this isn't about sitting there and looking at some, notion of, is monetary policy restrictive, or are financial conditions restrictive in some kind of absolute sense? It's really looking at the data, the totality of the data on the labor market, income, spending, on inflation, wages, and looking at the global kind of context of that and figuring out, is monetary policy moving us closer to where we want to be, or potentially moving us away, and trying to get that right. So that's true today. It'll also be true when we eventually get to a point where we're cutting rates. It will be the same kind of balancing act, trying to get that right balance.
Yeah, what does cutting rates look like? You said an adjustment from restrictive levels. Is that like a rate cut at every meeting? Is it just fine tuning?
If I don't know when we're going to cut rates, how are we going to answer that question? I think it's got to be data dependent. One of the things that market participants and others love is kind of having a certain path. Like it's going to happen at a certain frequency. And we know that can't be the way to do monetary policy. You got to be basing on what's happening out there. What's the outlook look like? What are the risks to that outlook? And so, from my perspective, this is a very different situation than we had a few years ago, where monetary policy needed to move rapidly and very decisively to get to a restrictive stance to bring inflation down, because there was a risk of unanchoring or unmooring inflation expectations. We need to act strongly. We did that, and that was successful. I think on the way, eventually, normalizing monetary policy, it's more of an adjustment process to kind of get that right balance, and it will be driven by the data. And of course, there's I'm really trying to get you to say R star. But
I was going to,
yeah,
just,
okay.
this is my
So
follow-up.
so there's
R-star.
also the big question. We don't know. We
Which-
can't know, like, what's the end point anyway on what the interest rate is, and that doesn't really matter right now. Eventually, as you move into, when interest rates get more closer to normal levels, of course, that will be a big question.
Right, and for all intents and purposes, R-star is normal level, right? Where it's not
Yeah.
restricting, it's not
It's
not accelerating an
it's the
economy.
Goldilocks interest rate.
But there's a debate, feels like, inside the Fed about whether we're in some sort of new normal economy where R-star should be higher.
Well, we don't know the answer to that question. And for someone who studied this for a long time, I think, what's important is to recognize that there's a great deal of uncertainty at any point in time. Some people are kind of saying, well, R-star is especially uncertain now. Well, it was uncertain when Thomas Laubach and I wrote about it in 2001. So, and we emphasize that in our first paper, as have many others. So I think we have to recognize that we don't know, A, what the level of that is, B, that we don't, we can look at the factors that influence it, which are things like demographics and productivity, demand for, U.S. government securities, other factors that influence it, fiscal policy. So we should be analyzing those and trying to understand that, but always with a big dose of humility that the decisions were going to be made or not going to be decided by, is your estimate of R-star, A or A plus, 1/10 or minus 1/10. It's got to be looking at what's happening in the economy.
But is there anything post-pandemic that you think has changed about the economy structurally where you would need to look at it differently?
So it wasn't so hard to get me to answer this question. I think, you look pre-pandemic, a lot of people wrote papers on this, other people who analyze this. What were the big drivers globally of lower interest rates, 10-year treasury, short-term interest rates? Just think about, why are interest rates in 2018 so much lower around the world than they were in, say, 1998, for example. So some of it was where's the economy? The ECB was still dealing with low inflation. There were some cyclical factors that were affecting interest rates, not so much in the US, but in other countries. So some of that's cyclical, but a lot of it was structural. Clearly something had changed from the 90s, 80s, 90s down to
technology?
Well, I think some of the things that drove it from the research that people did, one was, during periods of high investment, high productivity booms, or other big drivers of investment, we tend to see that's higher demand on savings, higher demand on funds, and that pushes interest rates up, puts up the neutral rate. We hadn't seen high productivity growth in a long time. We've seen normal productivity growth in the US and around the world. Around the world, I should double underline, because it's not just a US phenomenon. The other is demographics. Around the world, we're having fewer kids. People are living longer. That tends to reduce the demand for investment. You don't need to build as many roads, schools, factories when there's lower population growth. People living longer in most countries means people saving more for retirement, all else equal. And so looking at those factors, none of those have changed. I mean, it's getting a lot more attention. The birth rate, it's getting a lot more attention today, but economists have been writing about this for a long time, as have others. The productivity data haven't yet changed. I know there's an AI question somewhere lurking in this,
Yes.
But we haven't seen a structural shift in productivity around the world. And we haven't seen structural shifts in any of those things. So why do people talk about higher R-star? One is the economy's been amazingly strong with the high interest rates. So is there a signal to take from that? The other story is that fiscal policy around the world, higher debt. I think that makes sense. Higher debt around the world means higher interest rates. How big that effect is, I don't know, but that's definitely something I would take seriously. But I'm not sure if it's a huge effect. The other factors you usually hear about is the renewable energy or green transformation, deglobalization or fragmentation. Some of these arguments. Honestly, it's not clear. These are all things that could happen, might happen, maybe not happen in the future, that would change the supply and demand for savings around the world. So I think people are asking the right questions. I'm not sure what the answer is to those questions. Does that mean higher interest rates or not? I get the story, but we haven't seen in the data. So the data. So if you look at the US economy, if you take, let me just pick one model of R-star. Mine. And so if you use that one, the current estimate of the neutral real interest rate, Fed funds rate, is 0.7%. I'm not saying that's true. I'm not saying that's how I base my decisions. That's not how I do it. but that is where it is. Where was it before the pandemic? It's essentially the same. If we look at the estimate for the Euro area, which we do also, it's around 0.5%. The ECB has put out a report on their estimates of the neutral rate, and there's lots of them, a big range of them. They average around 0.5%, roughly where it was before the pandemic. So my point here is not that RSR hasn't risen. My point is I don't know. The data we have through the first part of this year, there's no sign of the neutral rate yet having risen. Doesn't mean it won't, but it's basically what's happening is that rise in inflation is mostly reversed. Monetary policy got tighter. It's eventually, countries is going to reverse. So far in the data, it's not screaming, oh, it must be higher interest rates are needed to stabilize the economy, because inflation is coming down without really high interest rates around the world. Last thing I'll say is, and this is kind of bragging a little bit about the model, is when the neutral rate has changed in the economy, looking back, we've seen it, these models pick it up. It's not like you have to wait 10 years. The decline in R-star or the rise in R-star that we found around when we first wrote the paper showed up in 2000 from the techboom.com bubble. It was that was there. Similarly, our estimates fell in 2009, 10, and we're kind of leading the market on that. So I think that, my point is these models are helpful to think about this. There's a lot of them that give different answers. At the end, there's a lot of uncertainty. We don't know the answer. And for me, importantly, I'm not sitting around holding my little cue card telling me what R-star is when I think about what we need to do for monetary policy.
But we have a way to go from 5.25% down to your R-star.
Which would be like 2.7, and 7.7 plus 2%, yeah, for the inflation.
Does AI factor in? And
so that to me would be the classic example of if AI does what some people are now writing it could do, would be a classic example of massive increase in demand and productivity in the economy for investment, and around that would lead to more demand for funds and for savings that would push up the neutral rate. We did see the neutral rate estimates rise quite a bit in the mid 90s to early 2000s because of that. So that would be completely consistent with how I think about the world if we got a sustained, sizable rise in investment and productivity from AI. Now, the big question is, will we get a large and sustained boom in productivity and investment from that? I think we're seeing the investment part happening, so that's starting to happen. One of the big issues with this is how transformative is AI to the underlying trends in our economy. And so the way I tend to pose this question is, for the last 100 years, we've been generating about 1.25% to 1.5% productivity growth for 100 years. This is an amazing accomplishment. This is unbelievably amazing that this economy, year after year, turns out higher and higher productivity. Sometimes a little faster, sometimes a little slower, but just does this. So the question I think I keep asking is, 10 years from now, when we talk about the AI boom and all the articles and the interviews you're doing about AI, will this be the name that people associated with the 1.5% productivity growth that we got between 2025 and 2035? Like automation was, like mechanization was, like computerization was, mostly like the internet was. So there's always been, if you look back over 100 years, things that happened that got us that 1.5% productivity growth. And if those things hadn't happened, we wouldn't have had any productivity growth. So I think that's the question I have for AI. Is it the thing that's going to drive us to get better and better in our economy? Or is it the thing that actually is way above and beyond, which we have had, after World War II, we had an amazing productivity period for quite some time. We had a mini boom with .com. We had no productivity boom from social media, but from all of that.
Maybe negative.
Yeah. So, but no, you think we just always have to ask us. Another thing about productivity in the U.S. economy is for the 100 years before kind of until maybe 20 years ago, a lot of our productivity growth was from education. America went for over a century from a country of basically people mostly working on farms without a lot of education to a country that's mostly, vast majority of people not working in agriculture, but higher and higher and higher educated. Both in K through 12, but then going to college, graduate from college, getting graduate degrees, all those things. That's been a huge driver of productivity in this country. For the last 20 years or so, we have not seen much improvement in educational attainment for people in the country. In other words, we kind of plateaued in that.
Mm.
And so when, again, if you go to AI, it gets to the 1.5, how much of that is just making up for the fact that some of the drivers of this amazing productivity journey are kind of not, or, missing today. And it's the thing that's just going to help us keep getting better. But this is an open question. We're going to, I'm not trying to be negative about it. I'm just saying there's a reality check here that we've had amazing revolutions in our economy for a century. And now we look back at them and we kind of just say, oh yeah, that's how it works.
Right. Well, I guess TBD on that. And before I open it up to the room, one more on AI from me, which is there's a lot of spending going on right now.
Yeah.
Is this inflationary or disinflationary or deflationary?
Well, it depends on how it ends up being used. If you think about in the past, when you have a productivity or innovation-led investment boom, that tends to be disinflationary because basically it's a shock to the supply side. Yes, it's a shock to the demand side too. Told you I know 2 words. So it boosts supply, but it boosts supply by more than demand. So we've seen that in eras where mechanization and automation and all that, it increases both, but probably increases at least in the short or medium term, the supply side even more. So I see that positive supply shocks, like I said, make my life a little bit easier, somewhat disinflationary, but great for levels of income and growth.
Do you watch NVIDIA's stock price?
Well, you can't not because it's like in the headlines every single day. But one thing that's you didn't ask the question about what does it do to our labor market, but one thing that I think that's another big open question, and I don't have answers for. But if you think about one area that the jobs that will be replaced by AI or generative AI and these, a lot of those jobs, not all, but a lot of them, we have outsourced out of our economy for a long period of time. So I think there's effects here in the U.S., but there are actually effects around the world about how this is used in replacing people like call centers and software developers. I mean, a lot of these are the kind of jobs that have no longer been kind of efficient to do in the U.S. or maybe not as productive.
So you see us weathering it on the jobs?
Well, I don't know about weathering because I think it can be transformative and have big
Yeah.
effects, but it will have big effects in other countries as well. And I think sometimes people kind of focus, think about this as, well, what's going to happen to these particular job in the U.S. And I think it's much more of a global phenomenon.
Do you guys talk about AI and the impact of it at the Fed during the meetings?
We, of course, we're not allowed to use AI during the meetings,
Right.
but this is topic number one in economics, right? It was last year, it is this year. I think it's because many of us have lived through the innovation booms of before, and we saw some of not only the economic impacts, but also the effects on society, the hollowing out of the middle class, for example, that came with some of the earlier waves of technology. And similarly, we've seen with the interactions of trade and technology. So I think there's a lot of focus on these issues because we've seen how this has played out in different times. And I think even as a leader of an organization, I would hope that all leaders of organizations in this room are thinking about, we're all going to use AI. How do we do this to improve and strengthen the skills and abilities of our workers, our employees, and our organizations, and not just think of it as, okay, this allows me to eliminate 10% of the jobs. I mean, there's kind of a big question for us of how do we all use AI, which I think is going to influence how it affects our economy and how it affects our society. There's kind of a path that says this can be productivity enhancing, like mechanization was and the Industrial Revolution, or is this just a thing that people see as a way to reduce costs?
Yeah, boost margins. I'd love to open it up to the crowd. I think we have some microphones going around right here in the back.
First of all, thank you for doing this. This was great, really educational. Sara, great to see you again, and great interview. Tomorrow we get the PCE, as we mentioned, right? And I believe, Sara, we're looking for 2.7%. What delta from that, what variant from that would raise your attention even more so? So I would assume if you hit 2.7, it's probably steady as she goes, right? If it were a 2.5 number or a 3.0 or a 3.1, what delta would capture your attention even more?
This is my kind of question.
Yeah, I noticed. So I didn't know you were allowed to plant questions.
I did not plant them.
I'll give you, first of all, don't say those big numbers anymore. I don't like that. Speaking of jinxing things,
Do you know the PCE? You
no,
don't get
I
it
do
advanced.
not. I do
Yeah,
not.
okay.
Just
Want to clarify.
Yeah, I mean, we have the CPI and PPI like everybody does, and we have analysts like all the banks, investment banks do, who tries to figure out based on the CPI and PPI kind of what a PCE, because those are the main inputs into the PCE price index. But there's other things that the Bureau of Economic Analysis does that they have to figure out on their own. So there's always a little bit of I'm not quite sure how some of the pieces will fit together. My honest answer to your question is, I can't just get focused on one data point. We've seen the CPI and the PPI. If there was a big surprise, at least from my perspective, on the actual PCE, it would probably be in the non-market components. And yes, I'm going to get very geeky for a second, but things that they're just making a guess until they get real data or something to fill in some blanks. That's true of GDP. That's true of everything. So I guess my point would be, it's another important data point because, of course, our long-run inflation goal is based on the PCE price index. I take it very seriously, but it's just one piece of information. Trying to look at all the pieces and how they fit together is much more important. Obviously, from my perspective, I liked any data is confirming that we're moving towards 2% inflation, that there's not signs of somehow discordant with that, but I'm not responding to any particular specific thing. And this issue about looking at the data, I know there's sometimes criticisms of the data because some of the data are based on actual prices. If a box of cereal of this size, they're getting the actual prices that consumers are paying. A lot of things are like that. Other things, whether it's the owner equivalent rent, meaning the imputed price of housing that people own, that live in their home that they own, or some of these services that aren't really priced. Those data always have kind of idiosyncratic things. They're part of the inflation index. They're important. I don't ignore them, but it's kind of important to understand like what's happening underneath. And that's what this MCT is using a statistical method, is trying to say, what's the signal in inflation for future inflation? And that's why I find it a useful thing as looking at a lot of other things.
Still, the market would probably sell off north of 2.8%, don't you think?
You're not asking me
All
this
right,
question.
Asking hypothetically. Anybody else? Yes. We have a microphone.
We do,
Yeah.
and they work.
Sorry, I'll jump in
Oh,
quickly
okay.
on just a credit question. One of the things we keep talking about, lower rates based upon inflation coming in. We haven't really touched on a credit cycle or something that triggers the Fed to react to lower rates, to trigger either liquidity in the market, et cetera. You have buy now, pay later, and you have private credit, two very big asset classes that have grown in the last several years, to a great degree, with a lot of players in it that are not traditional underwriters. Just any thoughts on the credit cycle, normalized credit cycle? Are we going to see one, or in your view, is those asset classes even a concern?
Well, I mean, the financial system in the U.S. is changing all the time, and you mentioned, private lending in particular gets a lot of attention, as it should, because it's grown a lot. And one of the things, lessons of history, is the things that grow very rapidly to a very large size. We need to understand them, and there may be vulnerabilities or issues or other aspects that we want to make sure we understand. I think in terms of a credit cycle, I mean, what we're seeing today after the unimaginable events the past 4 years is, both on the credit side and on overall financial conditions, I think things kind of lining up to this basic story. It's a strong economy. It's a pretty good economy, more normal economy. So, we're definitely seeing this evolution of different kinds of things, which we're studying. But, some of this is actually kind of filling in gaps that banks maybe have moved away from. I'm thinking about private lending, for example. So it's just, to me, it's a part of the evolution of our financial system. It's our job to understand it and make sure that, we're watching this, but not seeing anything of beyond kind of overall favorable conditions in credit markets. It's not seeing anything beyond that. In the banking system, I mean, clearly we got more of a mixed message where, credit conditions or lending conditions tightened last year in spring, but since then they've kind of stabilized.
Thank you. A lot to digest here. You haven't touched about the geopolitical risk or scenario. Can you speak about how it evolves if there's a geopolitical scenario continues to be shaping up the economy?
Right. So clearly there's a lot of geopolitical issues that we're seeing around the world. I think, the because the question I often get asked, and maybe I'll go to that part of it, is how do we include this in our analysis of the U.S. economy? And it really is thinking about the channels by events around the world, whether in China, Middle East, or wherever, is how is it, what are the primary channels that affects the U.S. the economy, the growth, inflation, financial conditions. And so looking at commodity prices, which is one indicator that that tends to be affected, which we haven't seen really, like oil prices and stuff, move that much recently. The other is in overall financial conditions. It tends to be when there's geopolitical stress or other financial market stress. There's a flight to quality, a flight to safety to the U.S. dollar that tends to come to the U.S. And then looking at the more macro environment, I would just say that overall there are these risks. The concern is how do they spill over to international trade, supply chain issues, maybe commodity prices, and we're seeing a little bit of that. But overall, so far that's been relatively contained. But that's just an area that could change.
Okay, really quickly, because we can't finish a family lunch without a political question. And I know the Fed doesn't do politics.
Yes, you can. You actually can.
And you don't pay attention to the election, and it doesn't impact monetary policy or anything. But we do have an election, and the Fed is a topic. And I do wonder if you worry longer term about Fed independence, given some of the things you're hearing.
Well, I'll just speak. I've been at the Federal Reserve now almost 30 years, and it's just an amazing institution. It's an institution of people who are dedicated and committed to price stability, maximum employment, and all the things that we do beyond monetary policy. And I think the important thing about the independence is really that it's an organization, and it's true of our peer organizations around the world, that is just focused on doing our job well. We have a relatively narrow set of things that we're supposed to do them as best as we can. We don't always get it right, that's clear, but we're always trying to do that right and not interested in partisan or other politics. And we've seen from the evidence and research, the independent central banks actually do perform better in terms of achieving price stability, achieving well-anchored inflation expectations. It's a model that works well. It's one that I've been very fortunate to be in for 30 years. And for me, the most important thing is we just continue to do our jobs, to do the best we can to meet the goals, objectives that Congress set out in the Federal Reserve Act and just continue to do that.
All right, so far so good. Thank you very much,
Thank
President Williams.
Well, Sarah and John, thank you both for your remarks, framing things, and then engaging in such a constructive conversation. To the club members, thank you all for joining. And let me just remind you that we have a run-of show for the next month or so with lots of interesting things. Glenn Hubbard and Larry Summers on June 4th, Oscar Eustis of the Public Theater on June 10th. And on June 13th, quite importantly, we have one of our signature lunches with Secretary Janet Yellen, and it is the Pete Peterson Excellence Award winner, and that will be a special privilege. We also have Strauss Zelnick and Lisa Cook later on in June. Let me also remind the club that, as we were just pointed out by Sara, that we have a presidential campaign coming up. After the conventions, we will invite both candidates to come and speak to the club. We don't know who will accept and who won't accept. We'll offer invitations to both, and whoever accepts will be glad to host, is the policy that we'll be working on. Let me just say thank you again to the 376 members of the Centennial Society who have provided underlying support for the club, for which we're all most appreciative and allows us to accomplish everything that we do. So everyone, thank you very much for joining for our program. Thanks again to our moderator and our guests. Everyone have a wonderful day, and those with us in the room, enjoy your lunch. Thank you.